Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. It's been a while since I've made a video. The market's been tanking, a recession is looming, inflation is high, things are bad. What are you going to do? It's a good time to have a long-term mindset, to kind of look at your investments, decide if they're worth keeping for 5 to 10 to 15 years, because eventually the market's going to recover. Even if things look bad now, and they may look bad in the next couple of months to couple of years, they'll eventually recover. That's why I primarily invest in the S&P 500. I know that will eventually recover. When you invest in individual stocks, there's a lot more risks, but also a lot more reward when you are right. Certainly, if you have been, for example, a tech investor in the last year or so, you have been punished immensely. Hopefully some of those stocks will recover, but if you have a long-term mindset, there's probably a lot of stocks there that are a real good buy when you look 5 to 10 years from now. We'll talk about INMODE today, which isn't really in the tech space, but I think they are an interesting company with where they're valued today. Of course, any of these stocks we talk about could go lower in the short term, especially in a market like this where even good companies are being punished simply because there are unknowns out there. If a recession happens, even great companies like Google will start to drop revenue. A lot of things will get cut. A lot of companies will fall even further than they've fallen right now. But it's hard to gauge that stuff. So it's always, keep investing, keep being disciplined, and all of that stuff. InMode is an Israeli-based company that we'll talk about today. They make medically accepted minimally invasive technologies that kind of do a variety of things, mainly in the plastic surgery space, but also in the women's health space and gynecology, skin health space, dermatology, ophthalmology, etc. We'll take a quick look at their investor presentation here and then kind of talk about some of the financials. This company went public in 2019. They've been around for quite a bit longer than that. They make all of these machines, they service them, and they also make little handles that you can use with these machines that do different things depending on what you're looking for. So let us look at this sucker here. Let's look at all the slides and see where we want to go. So InMode, who we are, not us, including myself, but the company, leading global provider of innovative, minimally invasive aesthetic and wellness solution with strong brand recognitions. They used RF technologies to provide specialized aesthetic and wellness solutions to plastic surgeons, dermatologists, ENTs, etc. They have worldwide regulatory approvals, a lot of peer-reviewed clinical data. You can see a lot of that stuff on their website. They have a history of profitable growth. This is why I'm interested in a company like this. This is a free cash flow producing business with a great balance sheet right now. You want a great balance sheet if you are looking outward and seeing a recession on the horizon. You want a company that can kind of self-sustain even if revenues drop a little bit, even if things sort of look murky in the upcoming future. Global platform with an established direct sales force and extensive distributor network. Really, that's a lot of their business model. They go out to doctors' offices, they sell their machines, they service their machines, and that's their risk as well, because once they kind of run out of doctors to sell to, or if some doctors are not interested in their product, that may be an issue in the future. It hasn't really been an issue right now, but they have a pipeline to expand medical offerings and even improve their current machines to add different technologies to those machines. So if you have a machine at a doctor's office, you may be able to go back there and say, hey, we added this new adapter and you can do this other thing with it, which is a cool thing. And a proven management team with an extensive business, scientific, and technology experience. And InMode, by the numbers, this is their latest earnings, $85 million in revenue in quarter one. This is a $380-ish million a year revenue business, projecting about 400 in the next year, in 2022 rather. This is a profitable business, 40 cents earnings per share, non-GAAP. GAAP is pretty close. Their non-GAAP margin is 83%. This is gross margin. Really impressive gross margins in this business. Really impressive operating margins in this business. This is like a tech model that's somehow not in the tech space. Their margins are really impressive. Non-GAAP income is really impressive. Most of that money flows down into cash flow. I think they have like 100+% conversion in 2021. 6,100 US installed base, 12,700 unit installed base. These are for their machines. They sell in 77 countries, a lot of direct sales reps, and they have a bunch of patented technologies across 10 product families. INMODE team, Moshe Mizrahi is their CEO. This guy is a co-founder and CEO of Cineron, kind of a serial inventor. The one negative about Cineron and the companies he's worked on before is they did go public. They kind of sold to a private equity firm, I believe. Long-term return on that one was pretty mediocre, sort of in that low single-digit space. So they kind of did well in the beginning, kind of trailed off towards the end, sold off the company. He moved on to this company. Is that the case with InMode, where they're really soaring right now, but as their technology becomes ubiquitous, if they can't find other doctors' offices to sell to, are they going to sort of die down? That's the risk you're taking with an investment like this. Certainly growing really quickly right now. Will it happen in the future? Who knows? This is a global organization selling in 77 different countries. Again, half of their install base is in the United States, but the other half is outside of the United States. 157 of those 189 people that are direct sales people are selling in the United States and Canada. They have logistics centers. They have wholly owned subsidiaries in Europe. They have headquarters in Israel. One thing to remember is that a lot of times when you're headquartered outside the United States, whether it's Europe, whether it's in the Middle East, the multiples you get for whatever reason are just lower than if you were in the United States. And that's kind of the case right now. Something you have to keep in mind. Are these multiples ever going to expand? Is this company ever going to be given the valuation it deserves based on their current growth? Who knows? Right now, everything is kind of out of favor. This is a company that was trading at $90+ a year or so ago. It is now trading at $22, despite growing their earnings, despite growing their revenue. So the market's changed. Is the market going to change back to rewarding positive growth and rewarding companies that are doing what InMode is doing? Who knows? Right now, that's not the case. Certainly, a recession doesn't probably bode well for an industry such as this one. People are going to cut back on things like, personal aesthetics. And this company is mainly in the personal aesthetic space. They work with plastic surgeons quite a bit to do a lot of what they do. So the evolving aesthetics market, this is what we're talking about. There's laser procedures, non-invasive, in-home maybe, topical procedures, or typical laser treatments like removal of hair, etc. There's plastic surgery, which is pretty invasive, basically surgical procedure with general anesthesia. You got to recover. There's incisions, there's scars. Can't really do that too often. Then there's something in the middle, and this is where these guys come in. You want something that's comparable to plastic surgery, but without the need for full surgery, right? There's still somewhat invasive procedures that they do. You can watch some of the videos within this presentation. I won't do that. I'll skip those, but if you are interested in the company, I urge you to kind of look at this presentation and see what they actually do. There are a lot of patients out there who probably want to do something that makes them look better, that makes them feel better about themselves, but maybe they don't want to do the full surgery thing that plastic surgery offers, and maybe they don't feel like the laser procedures, they're just not good enough. They don't last long enough, and you have to keep repeating them. Whereas this kind of meets in the middle, where it produces pretty good results without the shortcomings of full surgery. And that's sort of where they are. They're moving into a new paradigm, as they call it. This is potentially the new way that we're going to look at plastic surgery. This is less invasive. This is, in their mind, obviously better. I don't know if it's better in my mind, but certainly the results speak for themselves in terms of what they're able to do in terms of revenue growth and how profitable they can be with this technology. Is anybody else going to come in and compete with them in this space? It's possible. Obviously they have the proprietary technology. There's patents for this, so there is some backstop there. But again, it's possible that other companies come out with technology that's similar-ish to this, and maybe even better, that pushes them to reduce those gross margins, to reduce those operating margins. Anytime you're operating in an industry where gross margins are 80+% and operating margins are 40+%, somebody's going to look at that and say, I should do something like that because it's obviously very profitable right now. And these type of long-term profits are difficult to keep. So we'll see how that continues throughout the years. Again, we kind of talked about the evolution from traditional laser-based aesthetics to minimally invasive aesthetic surgery, which is what InMode offers. Who do they serve? 100,000 plus surgically trained physicians in the US, 200,000 plus globally. Not all of these physicians focus on aesthetics. Many do perform aesthetic procedures. I see a regular doctor that has a sign for one of their machines actually in their waiting room. So I'm like, I kind of how I came to know this company, and I looked at their financials and I was like, wow, that's interesting. Um, Obviously, I don't use their stuff. I've never had the need. I don't feel like I will ever use that stuff. But if other people are using it and their financials are solid, there is obviously a customer base that wants this type of uh, procedure. And they look at, hey, GYNs, ophthalmologists, plastic derm, aesthetic surgeons, ENTs, etc. And all that leads to a lot of this good stuff. I'll go to the slides again because the next couple of slides, the next 10 to 12 slides kind of show what they do. Radio frequency assisted liposuction. You can kind of see what they're doing here. A couple of videos before and after some of these procedures, hands-free remodeling, some of their machines, etc. You can kind of see a variety of their machines. We'll jump back in on slide 34 here. These are their platforms. These are the hand pieces that it can be sold within these platforms. So they make money in essentially 2 to 3 different ways, right? There's the platform that they sell to the doctor themselves. These are the machines that the doctor uses to perform these procedures. Some are surgical, some are hands-free, some are traditional laser. They have a variety of different applications. Some are just for the face, some are for the body, some are for the face and body, some are for women's wellness, some are just for hair removal. And then within these machines, within these platforms, they sell a different variety of hand pieces that are used for different procedures. And that's the second part of their business. They can, hey, we have this machine that you've released, that you've purchased from us rather, sorry, but we also have now released this other hand piece that allows you to do this other thing, and they can make additional money from each platform that's sold at a doctor's office by releasing additional hand pieces. And the third part of their business is, hey, your machine broke, we will come and service it. Your hand piece broke, we will come and service it, or we will sell you another hand piece if that's the case, right? So obviously, they're not just a one-stop shop where they sell you the machine and they're gone forever. They service that machine and they potentially introduce additional hand pieces to some of these machines that may allow you to do more things with the machine. And they continue to iterate and release new machines as they are maturing as a company, using some of those additional funds that they free cash flow from the business to expand upon their business model, not just focus on the face. Now they're focusing on the body, the women's wellness area, the hair removal area, etc. And all of that means is that the revenue is continuing to increase. And this is where I became interested in the business model. And this is where I've started to accumulate some shares here, knowing that this is a very volatile market. I haven't taken a full position yet, but I've started to buy a little bit here and there. And I will continue to buy if the company stock keeps dropping, because this is a business that's grown really well, that's relatively static in terms of its growth, and it's exploded since 2020 post-pandemic. I don't think this explosion in growth will continue. You're not going to see 80% growth again in 2022. It's going to kind of stabilize. But the good thing, you kind of see, hey, the pandemic happened and these guys did pretty well. They managed to actually grow their revenue in 2020. They managed to actually keep being profitable in 2020 despite what was going on in the world. They took that experience and grew it further in 2021, almost doubling their net income. You can kind of see what's happening quarterly, quarter over quarter. They're continuing to grow. Their net income is positive. Most of that net income, all of that net income essentially transitions into free cash flow. Their free cash flow in 2021 was almost 170 million, so almost all of that net income. This is a business that throws off impressive gross margins. Like I said, they have outsourced manufacturing at fixed costs per unit with long-term partners, which is why their gross margins continue to be really solid despite the inflationary pressures into 2022. They have sustainable tax advantages based on where they are headquartered in Israel, with a corporate tax rate between 7.5% to 10%. That's really solid. And that's really it, right? This is the presentation. You can look at it in more detail. They have some stuff about marketing to consumers with a brand ambassador, Paula Abdul, etc. Bunch of wins that they have, marketing to doctors, etc. They have a variety of doctors that they work with, calling it game-changing technology, etc. So interesting business model, interesting company we have here. Really what matters is what do their financials look like? What am I actually paying for this company today? Again, you have to remember that this is a very volatile market. If you look at this company, it's down 51% in the last year. Year to date, it's down 70%. So quite quite a loser if you were buying at the peaks of the market. But you can basically look at 60 to 70% of growth stocks, probably even more, in the last year have done the same. Not anything to think about too much if you feel like the business is going to be profitable and is profitable. If you bought at IPO, you're still up over 50%, but obviously the business was priced at a lot higher multiple a couple of months ago, 8 to 9 months ago than it is today. What's happened since then? Well, the financials continue to be solid. Year over year growth was, like I said, 73% in 2021. If you look at the quarterly results, continue to be solid. Let me tighten this up a little bit. 31% growth in 2022. Expectations for estimates in 22 are a bit lower growth. These guys, if you look at their first Q1 call, they basically said, hey, we're expecting somewhere between 415 to 425 million. And these guys have been known to kind of undersell. If you even look at their Q1 expectations that they announced a month before earnings, they said, well, we're probably going to be in the low 80s, and they ended up being a bit above that. So they've been known to undersell in the past. So this is kind of on the lower end of their scale, growing about 16%. Obviously, growth is slowing down here, but this is a business that's still going to throw off 40% plus net income, 180 million in cash flow, 210 million in 2023 cash flow. And this is all for a business that's currently valued at 1.8 billion in market cap, 1.4 billion in total enterprise value. Like I said, you want to be looking at businesses, or I want to be looking at businesses that have a balance sheet that can stand some volatility, right? If we do go into a recession, a business like this could be affected, probably will be affected. Are they going to be able to sell as many machines as they have in the past? The majority of their business, 80 to 90% of their business is still based on selling those machines. It is not based on servicing those machines and or selling those handheld units for those machines. However, if you look at some of the data here, that side of the business is growing. Their consumables and services business grew 79% year over year. Higher, that basically means, hey, more people are seeking these types of treatments along with their expanding install base. So that part of the business is going to become a bigger and bigger part of the business as time goes through, but it's still going to take a while for that to happen. And until that happens, and that might be years and years, potentially decades away from now, this business is going to be very dependent on continually selling those new units and replacing the units that they already have installed. So if they're not selling units, if that starts to drop off, this business is going to drop off pretty quickly. And that's the main risk you're seeing here. That's the main risk you're taking here. They have an install base of 6,100 units in the United States, 12,700 units worldwide. They need to keep expanding that and growing that. As they expand that services and handheld business, consumable business is going to grow. But that's going to take a while to become a big part of the business, to become free cash flow positive on its own, probably. This business is still very dependent on selling these units. The good thing, though, is if you look back at their sales, let's say even in 2019, even if their revenue were to drop by 50%, they're still free cash flow positive at that level. That's because their gross margin, because of their fixed costs, they continue to be free cash flow positive at that level. They could probably drop even more and still be free cash flow positive. That combined with their stellar balance sheet of $400 million in cash and no debt means they can weather a recession pretty well. Now, that doesn't mean that their stock price at $22 is going to stay at $22 if that starts to happen. If their revenue starts to drop, if a recession happens and they're very impacted by that recession, this could be, a 50% drop easily, right? That's kind of what you have to keep in mind. In the short term, these companies, especially in a market like this, where there's a potential of a recession, where tech companies are laying people off already, where other companies may follow suit, in the short term, prices may have a lot more downside potential, right? If this stock is 50% off a year from now and we're in the middle of a recession and it keeps dropping, is that a massive surprise? No, unless at that point the revenue is still growing and you're like, well, this is even a better deal. If the revenue starts to slow down and people start to really look at what they're spending money on because inflation is a problem, this could be a short-term disaster, right? That's the case for any stock. But in the long term, is there potential here at today's valuation? You look at something like the S&P 500 that's giving you maybe just shy of 3% free cash flow yield. You look at companies like Google, which are in the 5 to 6% free cash flow yield. And again, all of those companies, even Google, will be affected by a recession, right? Their 10 to 12% growth rate is not going to continue infinitely if there is a recession, right? Ads are the first thing to get cut in a recession, and Google will be impacted. A lot of companies in the S&P 500 will be impacted, right? The S&P 500 will drop during a recession. Google will drop during a recession. Companies like INMODE will drop during the recession. But you want to look at companies that can potentially come out of a recession strong, and you can keep buying those companies during a recession without fear of a company going bankrupt or going out of business. I feel like INMODE, for me, seems like that type of company. They have the balance sheet to weather a couple of bad years. They have the ability to lose a decent amount of revenue. They might have layoffs if they lose a decent amount of revenue, but probably they'll still remain free cash flow positive. They can kind of hopefully quickly adjust to the new market norms and stop making as many machines, keep their gross margins where they are. I'm sure their gross margins will be impacted no matter what. But if they can stay free cash flow positive during a recession, or even if they drop below, you know that they still have the balance sheet to kind of weather that aspect of things. So we talked about valuations. Well, right now you're getting a 10% free cash flow yield on this company at today's prices. Very, very, very good value given what I know about the company, right? There's still risks here. Again, like I said, a lot of these companies may be a short-term thing. Are they able to keep their gross margins where they are for 5 to 10 years? The reality is probably not. Some other competitors are going to move into the space. New technologies are going to emerge that are going to put pressure on those margins. 80% gross margins, 40% operating margins, tough to keep that going for decades at a time. In the short term, there's obviously the fear of a recession. There's the fear of inflation and what that does in discretionary spending. This is discretionary spending. People don't need some of these procedures. But the type of people that do get them, maybe they're a bit more insulated from a recession than some others, right? This isn't the type of thing that people who are living paycheck to paycheck are probably worried about. This is the type of stuff that people who are rich are probably getting, I'm probably not in the space that the people who are their customer base is. It's not to say that only rich people get this stuff, but certainly maybe a bigger portion of their customer base is on the upper end of the income scale than in some other businesses. And maybe they're more insulated from a recession. And we'll have to see that play out. We really haven't seen this type of company, or this company in particular, go through that type of economic cycle. So we'll see what happens. But like I said, I'm less worried about a company like this than a company that's burning cash and potentially needing to raise more money when their stock is devalued by 70 to 80%. So that's the interesting thing here. I'm willing to take a risk on something like this at a 10% cash flow yield. Certainly really good, especially if they can continue growing their revenue, even at a relatively decent clip. Again, I'm not expecting this to grow at 70% like it grew from 20 to 21. Even if it's in the teens for the next couple of years, this might be a good compounder, simply because the valuation here is really solid at today's prices. Not to say that it won't get better, and not to say that there's not other good values in this market because there's so many companies that have dropped so much in the last couple of months. But InMode certainly stands out as a company with a solid balance sheet, an interesting business model that's not really replicated in other areas right now. Very, very good margins and a very, very solid valuation at today's prices. Wouldn't be surprised if it keeps dropping. Again, everything drops in a market like this one where people are starting to move to risk off assets. But this is where interesting valuations like this start to emerge. This isn't a stock that I would put all my money into simply because I think there is a lot of unknowns with this type of technologies. Like I said, the CEO's former businesses, they have a certain way of being really successful growth stories for a little bit of time and then kind of trailing off as the technology maybe gets as the technology changes, as other competitors in a similar space emerge. If you look at some of these competitors, I don't know who they're going to show here. They don't really have anybody at the moment in this space, but eventually somebody will emerge. Someone will look at these juicy margins and say, holy crap, I got to get into this business. So there's some risk here. I wouldn't say a lot of risk. There's some risk here. But at this valuation, it's certainly interesting enough for me to slowly taper some money into this stock because I think at a 10% cash flow yield with the growth they have, with the balance sheet they have, with the free cash flow they generate, it's an interesting business and one I'm certainly interested in. So let me know what you guys think in the comments down below. Thanks for watching. As always, guys, remember, I'm not a qualified financial advisor. Please do your own due diligence. Talk to a qualified financial advisor before making any investment decisions. Thanks for watching. Like and subscribe and all that good stuff. Hope you enjoyed it. Let me know if you guys want me to cover any specific companies. A lot of value here. I'll try to make more videos, but work has been busy. This is our busy season. Life has been busy in general. Certainly want to spend more time with my wife and all that good stuff. So thanks for watching and have a good rest of your day.